Seth Hicks, thanks so much for coming on the Infinite Banking Radio podcast, man. How's it going?
Doing great, Nolan. Thanks for having me, man. Really excited to talk with you.
Absolutely. Like I said in the intro, you've got such a unique business, just going back and forth with life insurance and then also not to mention entity structure and protection as you're an attorney. And so, man, I really want to dive into it a little bit. Can you but before we kind of go into it, like you just to talk more about, how you got into this idea and the business and the structures that you do now.
Sure. Well, yeah, I've been practicing attorney for going on 3 decades now, and I worked in a large firm uh, doing real estate transactions initially for large banks and also doing development deals. And the real estate section was an anchor of the law firm. So we got some good chops, so to speak, and experience in that. And then I spun out and went to back to work for myself in a little boutique business law firm where I actually tried cases and structured commercial transactions and real estate transactions for clients. Like I said, for going on 24 years now. So the way I got into infinite banking was actually through a client. And a client said, "Hey, you really need to check this out. Take a look at this." And at first, when he was describing it, I thought, "Well, this is gimmicky. This doesn't seem to be something that I'm interested in." But as I actually started to research it and I looked into some of the laws that protect these insurance policies, I realized that there's a superior way to structure transactions using life insurance policies, and there's a superior way to protect your assets with life insurance policies that you don't have to do anything special, jump through any special hoops or go offshore with offshore entities and structures. And you don't have to be even that smart. All you got to do is sign the contract with the life insurance company, and if you're in the right jurisdiction, you're automatically protected. So that was kind of the genesis of it, as a client brought me to it.
So can you go into some of the like you mentioned, I mean, I know when we talk about infinite banking, we always preach how important asset protection is, and how a judgment, depending upon your state and like you said, jurisdictions, creditors cannot attach liens to your policy and things like that. Can you go into some details on how powerful these life insurance policies can be in regards to creditor protection and asset protection?
Sure. Yeah. So the life insurance industry is regulated at the state level. It doesn't have a federal code or a law that applies to life insurance contracts and companies abroad. It's state by state. And so, interestingly enough, after the Civil War, many of the southern states enacted laws which tried to protect against carpetbagging. So, and the southern states protected their citizens through homestead protection laws and in their life insurance policies. Because, as you probably know, Nolan, before the current era in the 1900s, after the creation of the Federal Reserve and branch banking, life insurance policies were the way that people banked. So from the inception of the country all the way up into this phenomenon, which people are brainwashed to think is the only way to bank in branch banking, it was life insurance banking. And so the states thereby protected those life insurance contracts because they knew that's where their citizens put their money. They banked in life insurance contracts, and they knew that their homesteads were important to their citizens, so they protected their homesteads. So you'll find states like Texas, Oklahoma, Florida, all these southern states south of the Mason-Dixon line have laws on the books which protect their life insurance contracts and protect homesteads in a lot greater fashion than northern states or western states. Although there are some outliers. Some states do have protections in place.
Yeah, there's always an outlier somewhere, but we always like to just joke and say, hey, if you're in the southeast, you're just going to be fine. Well, can you go into, like you said while we were just speaking a minute ago, talk more about your real estate business, what you guys do at your law firm, and how you help clients again protect their assets.
Sure. Well, the anchor is utilizing the infinite banking concept to anchor your transactions, and you effectively create entities which act as a lending entity on your transactions. And whether you're syndicating money or whether you're doing deals by yourself, you always want to get the money back. You want to create a system whereby the money that you have into the deals is, one, secured and collateralized, and two, is also returning to your bank. Just like any other bank that lends money, like Wells Fargo, Bank of America, Chase, or any other lender, they're going to collateralize that asset. They're going to secure their loan with adequate collateral and equity in the deal, such that if payments stop, they're going to foreclose and take the asset back, liquidate that asset, and make their loan good. So you have to think like a banker. That's one of the fundamental concepts and cornerstones in the transactions, is you have to create a banking system, which is the insurance policy as the anchor of that, to lever these deals and to collateralize these deals. Now, once you've got that mindset in place, you've got a cash flow where you're getting multiple touches on the same dollar. The money that you paid in for a premium, you're also borrowing out in a policy loan. You're taking that same dollar and you're buying a real estate asset, in our example, which spins off rental cash flow back in debt service to your bank. And thereby you've created this cyclical volume of money that's at work for you. And that we call that the velocity of money. So that's kind of the 30,000 overfoot view of that.
So can you give us an example of kind of what that transaction would look like? If somebody's out there and they like what you're saying, they hear, man, I like infinite banking. I don't really know what the structure of that looks like in the collateral side of things. What does a typical transaction look like involving a life insurance policy like that?
Sure. Well, your lending entity is going to have the right to borrow funds out of your life insurance contract, and that's a contractual arrangement between the owner of the policy and the lender. And when the lender borrows that money, then they effectively put it to work, just like Wells Fargo or Bank of America or any other lender. And it looks just like any other loan transaction, where you've got a borrower that's entering into a promissory note and a loan agreement, and the lender secures the payment of that promissory note and loan agreement through a deed of trust or a mortgage, depending on the state. And that's in, like, let's say, a smaller residential type transaction. But if you've got a commercial context where we have business owners who have a lot of need for revolving credit, and they have large cash values in their policies, and their lenders are able to fund millions of dollars, we'll structure it in the form of a revolving commercial line of credit, whereby if they're buying farm equipment, or they need inventory, they need additional human capital, they're paying for more employees, whatever the case may be, they've got that line of credit to draw down from their policy in, but yet they still secure all of those payments, just like you would in a smaller real estate transaction, through a security agreement and something called the UCC-1 financing statement, which secures collateral that can move around, including things with wills, accounts receivable, intellectual property, paper property, and thereby the lender effectively has the first lien interest on those assets of the business, or on the first asset that's a real estate asset.
I want to take a step back, and I would like you to talk about life insurance. And like you said, you have, not only are you a practicing attorney, but you also are an infinite banking practitioner. You use these in your own lives and when you're purchasing real estate. How have you used your life insurance policies, and how have some of maybe your clients have used these policies to go and do the deals that you're kind of describing?
Sure. Yeah. Well, I mean, I think a typical transaction for, let's just say, bring it down to simple mom and pop type building blocks. Someone even out there that's interested in buying their first piece of real estate. They've got a policy that's in place, and as it's seasoned and has the cash value available, they take a policy loan out of that contract, out of their life insurance contract. They take the cash value out and they fund a lending entity. That lending entity then lends the money to a borrower, and the borrower purchases the asset, like the real estate asset. And then effectively the rental income comes back. They service the debt. They top off their policy again, and they rinse and repeat. So let's take a look at like a duplex, for example. In some places in the South and Southeast, you could buy a duplex for $100,000. It's not going to have marble floors, but it's it's going to bring some cash flow. So if you have $100,000 duplex and you purchase that duplex through money through your private bank, you're effectively got a first lien through your private bank on that asset. The rent's coming through, and let's say it's $1,000 a door in rental income. So you'll have $2,000 a month or $24,000 a year in rental income coming back. And for the sake of our example, we won't get too granular and think about, maintenance and taxes and insurance, but let's just say you got a gross income 24,000. You take that $24,000 on a monthly basis, you pay back your loan to the insurance company, your cash value steps up every month, and you've got that cash value ready to deploy for another asset. With that example, in a little over 4 years, not taking into account the PITI, the vacancy factors, any of those other issues, you're going to pay that loan back with your bank, and you rinse and repeat. Or here's another idea to throw at you. If you want to use the concept of leverage, you could take that $100,000, spread it across 5 duplexes, go out there and find 80% loan to value financing from another third party lender, and you've ramped up your gross cash flow by 5x there. And you've also ramped up your velocity and your cycle of money so that you're paying back your policy in a much more rapid fashion. And you effectively pay off those 80% LTV lenders very quickly within a couple of years, and you own that property free and clear, only indebted to your private lender bank.
Yeah, and one thing too, Seth, that when I have guys come in our office and we talk about, should we do we're thinking about doing this, or we're thinking about doing this. Fact is, infinite banking is not an or asset, it's an and asset. You get to do both at the same time. And so most people would say, okay, I'm going to go buy this duplex, and that's all I can do with it. But if you actually funnel money through a policy first and then borrow the money out to go do those deals, you're going to have your money still continuing to compound in the policy. All the while you've got the line of credit of the insurance company's money out deployed in the marketplace. So you're able to kind of earn on both sides of the coin. Can you kind of speak on that just a little bit?
Sure. I mean, I think in essence, we're talking about direct recognition versus non-direct recognition policies. And when you take the money out of those policies, in effect, in a non-direct recognition, it continues to be calculated as if it were there. And you've got that compounding tax-free growth inside the policy that your initial premium purchases, and you've also got the money that you've taken out and it's at work in a real estate investment. So you've got the double dip there, and that kind of blows people's minds to think, well, how can I use the same dollar more than once? But that's exactly how you do it. And where this really picks up speed and you start to see a parabolic increase is when the policy becomes more and more efficient after years 5, 6, 7, and 8. And when you're putting in $1 of premium and cash value, you're seeing $1.10, $1.15, $1.20 coming back in cash value to you. That's 20% that you didn't even put in, that you're getting compounding growth on, and that you're able to pull out and put to work for yourself in another place. There's no other business on earth like that.
No, you're exactly right. And I'll tell you one thing too, Seth, that has really blown a lot of my clients' minds is, obviously everyone says, oh, I don't want to pay interest on my own money. Well, again, we're not using your own money. We're using the insurance company's money. But when I say, I got a client that's actually a private hard money lender, and he'll go and take policy loans and lend it out at 12% and pay the insurance company back at 4%. Well, most people would hear that transaction and they would do the simple math of 12 minus 4 equals 8%. And that's nothing to write home to mom about. But if we actually look at what he earned and then we subtract the cost or divide it by the cost of capital, he's actually earning 300%. 12 divided by 4 is 3. So he's making 300% using someone else's money. All the while his capital is still, like you said, compounding and growing in his policy. There's really nowhere else out there in the world or any other financial investment instrument that can provide guaranteed contractual results similar to those.
That's right. I mean, well said. And I think also it's important to understand the power of tax-free growth within the system. I mean, when you compare this, uh, you know, one side of the equation where you're paying taxes on the money, and we do this analysis occasionally for people that have large sums in 401ks or other government qualified plans, and say that's really not your money in there,
Right.
and you're going to pay the piper at some point. And do you know what you're going to pay the piper? Do you know what the tax rate's going to be? And the answer is no, you don't. And with the the gross national debt at $31.5 trillion right now, and the printing of money continuing to just be out of control, it devalues the dollar. And you go, well, why does that relate? Well, it relates because the only way to try to balance that is through taxation. And they're going to tax the people with the money. This is something that politicians and the ultra wealthy have been using for centuries. And it's pursuant to Internal Revenue Code 7702 that says, hey, these life insurance contracts are a tax-free silo. And so that's why you've got the likes of John F. Kennedy and Richard Nixon, Ray Kroc, who founded McDonald's, J.C. Penney's, and on and on and on. Smart people are using this system for the same reasons and fundamental, values that we're describing.
Well, and not to mention too, to go on what you just said, it's the government is continuing to print money. We're going to keep going into more debt. We're going to keep devaluing the dollar. And like you said, it's the solution, sadly, is either continuing to print more money or to raise income through, like you said, taxation. We don't really have any other way of doing it. And the worst part is if it's a qualified plan, it's an asset that the government created. They can change the rules. I mean, who's to say that, like you said a minute ago, the tax laws today are the laws today. Who's to say that when the demographics and the financials change on our balance sheet as a country in the next 20, 30 years, that they can't say, hey, guys, I know we told you one thing, but we're going to have to change rules. And there's nothing you can do about it because your dollars are locked up. Well, hopefully investors like you and I, we have substantial cash value in our policies that aren't susceptible to the market or the government. We're going to be able to be taking advantage of massive opportunities while a lot of other people are just going to be swimming upstream.
You're exactly right. And I think that, our audience probably is of the opinion that they're a better manager of their finances than the federal and state governments. And, if you look at various programs created, Social Security, Medicare, Medicaid, you look at various things that have been implemented that are more socialistic in their planning, they're all failing. If they haven't already failed, they will fail. No one thinks that there's going to be enough Social Security money to go around. It's really a Ponzi scheme. And as our children we probably won't have any relevant Social Security, but that's why we're not banking on that. That's why we're implementing other systems where I believe that, and my clients believe that they're better managers of their financial future and their financial freedom than the government is. And if you put your eggs under their control, you lock up your money in these 401ks, 403bs, other qualified plans, you're effectively to blame, because you don't have to play in that sandbox. There are alternatives, and that's what we're trying to do. And educate folks as to alternatives and why they're so far superior to these other government qualified plans. But people have been brainwashed. I mean, they think the branch banking is the only place that you can bank, and they think that well, you've got to pay your fair share of taxes. You've got to do this. No, actually, I mean, it was interesting. If people in the last debate between Clinton and Trump, he said, "Yeah, I don't pay taxes because I'm smart."
Right.
It just right out there, it's like, I don't pay taxes. The guy's worth $10 billion. I don't pay taxes because I'm smart. So there are ways that you can effectively take advantage of laws that are on the books, like Internal Revenue Code 7702, put money in these policies and it grows and compounds year after year, tax free. You're able to pull that down in a retirement time period, sunset years, whenever you want, fully liquid and no taxation whatsoever on it. So there's one thing I wanted to mention too before we rabbit trail somewhere else, was the fact that the centralized banks have become increasingly less safe place to put your money. And do you know why that is? I'm sure you do, and I don't want to put you on the spot, but I'll give you a teaser. It's called Dodd-Frank Act. Do you know about the Dodd-Frank Act?
Educate our listeners, because I'm intrigued by this as well.
So the Dodd-Frank Act is misnamed the Consumer Protection Act. Okay. And it was passed over a decade ago. And effectively, it was passed in response to the bailout that occurred in the 2007, 2008 mortgage crisis, where too big to fail lending institutions went upside down, and the federal government used taxpayer dollars to bail those private entities, those private corporations out of insolvency. Well, never before has taxpayer dollars been used to shore up private entities. If they sink, they sink. That's the American capitalism.
Mm-hmm.
So, it was an interesting head fake, because what came from it was the Dodd-Frank Act, called the Consumer Protection Act. And what it effectively put into place was that we're not going to bail out private corporations with taxpayer money anymore. But what we are going to do is we're going to allow banking institutions to bail in on depositors' money in the event of insolvency. Well, what does bail in mean? Well, it means, like in Cyprus in the early 2000 teens, I think it was about 2012, Cyprus had a financial crisis and banks bailed in on their depositors' money. Everything over $100,000 they took 50% of. And so there's still litigation going on, people trying to recover money. They go, well, that's Cyprus. Every European nation has bail-in laws on the books. And you go, well, that's Europe. Well, that's what the Dodd-Frank does, is it's legislation that allows banks to bail in. And effectively, you and I think that, if you got money in Wells Fargo, you got money in Chase or Bank of America, that's our money, right? I mean, I got a statement, it says I got that much money in it, it's my money. No, what it is it's an IOU. And it's the bank saying, we owe you this money. But because of fractional banking and derivative lending, that money's actually not there. If you have $100,000 in the bank, Wells Fargo, for example, they don't have it there. They may have 10,000 on reserve, and that's actually a high estimate.
That's right.
Because if they have a lot of deposits, they have less than that 10%. We'll call it 10%. The other 90,000 of your money, they've got out in loans on real estate, on cars, on businesses that they're making money on. They don't pay you any of it because you don't make any money on your deposits there. And that's called fractional reserve lending. And effectively, that makes you and I the sucker if you put a lot of money there and you keep it there. The next thing I hear, well, if they bail in, I've still got the federal deposit insurance, FDIC. I've got FDIC insurance up to $250,000. Well, some of our clients, that doesn't mean very much because they got a lot more money than that. And you have to diversify among accounts, and it's a hassle. But here's the bigger issue there, is that the FDIC doesn't have the assets to actually insure all of the deposits.
That's right.
On hand in America. There's 20 trillion in US dollars in deposits from Americans in banks. And the FDIC has a small pittance of that on hand to make good on those loans. We're talking less than a penny per dollar.
Right.
And so why would you subject yourself to that if you don't have to? Why would you put your money at risk in a big box bank that is where the writing's on the wall? They keep printing money. banks, there are going to be bank failures, and which ones and how many, I think is yet to be seen. But I don't even want to subject myself to that risk. And I pray it never does happen, because I think it would create chaos in our country. But at the same time, if there's a superior, safe way to bank, that's where you should be banking.
No, absolutely. And that's another thought that we try and bring to clients. But, unfortunately, a lot of people are they kind of just do what they're told. They just kind of say, oh, my employer says to go to 401k and match and just do all these things that I think my brother-in-law told me to do, but they really don't use their own thoughts or do their own research or homework to decide, is this actually what's best for me and my family? Because like you said, people don't comprehend that the FDIC is very, very underfunded. Like you said, there's $20 trillion in deposits. You're looking at maybe $80 billion in that account that's able to. So I would look at it and think, I would rather have my money, if I'm keeping it in a safe somewhere, in the riskiest, most aggressive bank ever, because they're going to be the first ones to fail. And then they're going to be the first ones to get bailed out by the FDIC, with whatever is in that account. So for every, dollar that's in a checking account somewhere, you got a penny being insured by the FDIC. Well, on the other side of the spectrum, with whole life insurance or mutual insurance companies, for every dollar sitting in cash value, you're going to have anywhere from $1 to $1.25 on the other side of that counterparty. So in regards to risk, it feels like the banks are the safest way, but it's the most riskiest place that you can park capital, because there's nobody insuring those dollars, and there's simply zeros inside of a computer saying what you have in there. It's crazy.
It is crazy. It's absolutely crazy. But that's part of the brainwashing that's happened to America since the insurance policies were used for banking. And that's why I think you and I both are grateful for guys like Nelson Nash, who brought this back into American culture and really brought it into the light for people to look at. But you make a great point in that the insurance companies, they're not able to do fractional reserve lending. There's no derivative lending. There's no funny paperwork. There's no funny math in what they're required to hold on to. So it's dollar plus in reserves for every dollar that you've got in your contract. And in my experience, my partner, he's 70 years old. He's been in money management 40 years. He was a wealth manager before he made the transition into infinite banking. And he said he's seen 3 life insurance companies fail in those 3 years, and they were swallowed up overnight by other life insurance companies because of the cash on hand.
Mm-hmm.
They're really not insolvent at all. And so nothing missed a beat. No, there was no, there's no policy benefits that aren't paid. There's nothing. It's just simply a change in names, effectively, and in operations and ownership. Now take a look at it. I mean, I remember I was in LA in 2012. There was a bank run on IndyMac Bank. And there were riot police on mounted horseback and tanks in Thousand Oaks, California, in the streets to prevent people from mobbing on the bank. And fortunately, I didn't have any money at IndyMac, but that makes for rough times. And so again, if you can choose something else that has an asset protection and a vault to it, where you've got complete liquidity, it's in a tax-free environment, why wouldn't you make your own rules and play in that sandbox?
No, absolutely. And I know your time is getting short here, Seth, but I wanted to say one thing too, where I don't know if you've ever read the book, The Creature from Jekyll Island by G. Edward Griffin. Sure. That's one's like I try and read every other year but it's a pretty thick book to read. But what you're talking about, it feels really spooky, but it's all factual. It's all truth in regards to the Federal Reserve. Jekyll Island is a little island off the coast of Georgia where the richest men in the world back in 1910 actually took a train car out there and created the Federal Reserve. I mean, it reads like a fairy tale storybook, but it's real life. And so what you're talking about is 100% factual. And not to mention, all these guys knew all this stuff about life insurance, and they understood the power of keeping money in whole life that's structured for cash value. as ways to not only fund deals and to keep money safe, but also to pass on wealth to the next generations. And that's kind of one of the things that you and I are really on the same page with our clients, is showing people how to get outside of the matrix and to control their money versus having the IRS, their employer, or anybody else that can get their talons on their money.
Amen, brother.
So I get excited about it. I know you're the same way as I am. But well, before we get out of here, Seth, do you have? I mean, what I'll do is I'll put your information in the link of this bio. But do you have anything else before we get out of here?
I just want to encourage people, if this is new, if it's a new concept to you, that you actually do some critical thinking and look at what we're saying. I mean, we have a lot of resources on our website. I know you provide a lot of resources as well. People, put on your thinking caps and actually objectively look at the case that we're making to protect people, because I think you'll find, like I did, that this is not it's not a gimmick. It's not a false bill of goods. It is legitimately the best place to keep your money. It's the best thing to use for entrepreneurship, investment, business acquisition, business startup, business expansion. There's no superior method. And why wouldn't you want to be the bank and be able to do your banking in a tax-free environment, as opposed to giving all of that money to some other third party?
Man, 100%. You got me fired up on a Wednesday, man. That's awesome. Well, again, guys, this is Seth Hicks. I'm going to have his information in the link in this bio. But again, man, so much appreciate your time today, and I'm excited to see where things go in the future.
Absolutely. Thanks for having me,
All right,
Nolan.
man.
Appreciate
See
it.
you, Seth.